71% of new business owners default to sole proprietorship without understanding how it could put their personal assets at risk. Let's examine what's really at stake. At Venture Smarter, we guide businesses through critical structure decisions daily. Today, we'll address which structure actually protects your personal assets, how taxes differ between these options, and whether you can switch structures later without penalties. Our research shows the average sole proprietor facing a lawsuit loses over $70,000 in personal assets that would have been protected as an LLC. Our viewers have been asking great questions about business structures, especially about personal liability. Subscribe to join the conversation and build a legally sound business from day one. Point 1. Liability protection. The most critical difference? As a sole proprietor, there is no legal separation between you and your business. A client slips in your store, a product injures someone, or your business can't pay its debts. Your personal savings, home, and other assets are fair game for creditors. An LLC creates a legal barrier, a limited liability company, that separates business liabilities from your personal assets. This isn't just legal theory. We've analyzed hundreds of small business lawsuits where this distinction was the difference between financial recovery and personal bankruptcy. Point 2. Formation process. A sole proprietorship requires virtually no paperwork. You're automatically one when you start doing business. But this simplicity comes at a steep cost. An LLC requires filing articles of organization with your state and creating an operating agreement, and typically costs between $50,000 and $500 depending on your state. This small investment and an extra hour of paperwork provide the liability protection most business owners desperately need but don't realize until it's too late. Point 3. Taxation. Both structures offer pass-through taxation by default, meaning business profits flow to your personal tax return. The key difference? An LLC gives you flexibility to elect different tax treatments as you grow, potentially saving thousands annually. Plus, recent tax law changes have created new deductions that LLCs can leverage more effectively than sole proprietors in certain industries. Point 4. Credibility. 47% of business clients report more confidence dealing with an LLC versus a sole proprietorship. That LLC, after your business name, signals legitimacy, permanence, and professionalism that can translate to higher rates and more business opportunities. Point 5. Business continuity. A sole proprietorship legally ends if you become disabled or pass away. An LLC can continue regardless of what happens to any individual member, making it valuable for business continuation and estate planning. If you found value in this analysis of the difference between LLC and sole proprietor, you need to watch our video on LLC versus corporation. Subscribe now, and remember, when you structure your business correctly from the start, you're already on the path to venture smarter.